What if I told you that the biggest economic crashes in history aren't random accidents? They aren't bolts of lightning from a clear blue sky. Instead, they follow a script, a predictable pattern that repeats itself with terrifying precision. It's a pattern that doesn't show up every year, but only when a very specific, very dangerous set of ingredients comes together. Think of it like building a bonfire. First, you need a mountain of dry wood. In the economy, this is when prices for everything, stocks, houses, you name it, get pushed to ridiculously high levels. Second, you need to soak that wood in gasoline. This is the massive amount of debt that everyone takes on, from giant corporations to regular families. Everyone is borrowing, stretching themselves thin. Third, you need the belief, the widespread feeling that this fire will never get out of control, that this time is different. And finally, all you need is a single match, a trigger event that forces everyone to sell, to run for the exits all at once. These exact conditions were perfectly aligned in 1929, right before the Great Depression. They were there again in 2008, just before the global financial crisis. And right now, as we speak, every single one of those ingredients is back in place. I don't mean things are just similar to how they were before. I mean, they are identical. The stage is set. The actors have taken their places. And if history is any guide at all, the curtain will fall in a devastating crash sometime in late 2026 or early 2027. Now, this isn't me trying to scare you. This isn't some wild prophecy. It's simple pattern recognition. And I'm going to show you exactly how these crashes unfold, who gets wiped out, and who, surprisingly, makes a fortune. More importantly, I'll explain why this next crash could be worse than 1929 and 2008 put together. The numbers are bigger, the debt is higher, our global economy is more tangled together than ever before, and the people in charge have already used up all their emergency tools fighting the last fire, leaving the firehouse empty for the next one. What you're about to hear is an analysis of a crash that hasn't happened yet, but it follows a playbook we've seen twice before. The machinery is the same, the timeline is predictable, and the outcome, who gets destroyed and who gets rich, follows the same script every single time. Let's start by looking at where we are right now, the setup. Every single crash in history begins with a party, a bubble, and we are currently living in the biggest everything bubble the world has ever seen. It's not just the stock market. Real estate in major cities has soared to unbelievable heights. The average home in America costs over $400,000, while the average family makes about $75,000 a year. That's a ratio of nearly 6-to-1. To put that in perspective, a healthy, sustainable ratio is closer to 3-to-1. This means houses are almost twice as expensive as they should be compared to what people actually earn. And it doesn't stop there. Big companies are drowning in debt, more than ever before the last crisis. The government itself owes a staggering $36 trillion. The interest payments alone, just paying the fee on that debt, are costing us nearly $1 trillion a year. And then there's all of us, credit cards, car loans, student loans. It all adds up to over $17 trillion. When you pile all this debt together, government, corporate, and personal, it's over 3 times the size of the entire U.S. economy. Every part of our system is stretched to the absolute breaking point, all at the same time. This is the everything bubble. Everything is expensive, everyone is in debt, and almost everyone believes the party will never end. But why? Why does everyone believe prices will just keep going up forever? Because for the last 15 years, the Federal Reserve, the central bank of the United States, has basically guaranteed it. Anytime the market even hinted at falling, the Fed jumped in to save the day. They'd cut interest rates to make borrowing cheaper, or they'd turn on the money printers. This is what they call quantitative easing, which is just a fancy term for creating trillions of dollars out of thin air. This new money had to go somewhere, so it poured into stocks and real estate, pushing prices even higher. Investors learned a very simple lesson. Don't worry, just buy whenever there's a dip in the market, because the Fed will always have your back. This created a dangerous mindset, a belief that there was no real risk anymore. It was like playing a game with a cheat code for infinite lives. But here's the problem, the big, scary secret. The Fed has run out of cheat codes. They've used all their ammunition. For a decade, interest rates were practically at zero. They can't go any lower. And their money printing experiment grew their bank account from less than $1 trillion to $9 trillion. Pumping much more into the system would just cause prices for everyday things to skyrocket, which we already saw happen. To fight that inflation, they had to raise interest rates faster than they had in 40 years. While that cooled things down, it created a new nightmare. All that debt we talked about, higher interest rates make it more expensive. A company that borrowed money at 3% now has to find a way to pay it back at 7%. A homeowner with a 3% mortgage is replaced by a new buyer facing a 7% mortgage. And this massive debt pile is becoming a crushing weight. And now the Fed is trapped. If they lower interest rates to help with the debt, inflation comes roaring back. But if they keep rates high, the debt becomes impossible to pay. and the whole system could collapse. There are no good choices left. This is the setup. The most overvalued markets in history, the biggest pile of debt in history, and a Federal Reserve that is completely out of options. Now, let's look at the past, because the reflection we see in 1929 and 2008 is chilling. In the 5 years before the 1929 crash, the stock market went up 400%. People were borrowing money like crazy to buy stocks, convinced they were in a permanently high plateau, a new era where crashes were impossible. Then the collapse came, wiping out 89% of the market. Fast forward to 2008. The housing market had doubled in just 6 years. Everyone was buying homes with risky loans they couldn't afford, believing that house prices on a national level could never fall. Then they did. The financial system imploded and the stock market was cut in half. In both cases, the ingredients were identical: a massive bubble, way too much debt, and a popular belief that the good times would last forever. Then came the trigger, and then came the panic. The crash of 2026 will follow the very same pattern. So we have the bubble, the biggest one in history. We have the leveraged mountains of debt piled higher than ever before. And we have the widespread belief that the Federal Reserve can wave its magic wand and make any problem disappear. The bonfire is built, the wood is dry, and the whole thing is soaked in gasoline. All we need now is the match, the trigger. And unfortunately, there are several very likely candidates just waiting to provide the spark. Let me show you the 3 most probable triggers and how each one could kick off the whole terrifying chain reaction. The first, and in my opinion, the most likely trigger, is a collapse in commercial real estate. This isn't something that might happen in the future. It's already started. It's happening right now in slow motion. Think about all the giant office buildings in big cities across America. Thanks to the rise of remote work, many of them are sitting half empty. Companies that used to need 5 floors of space are now getting by with just 2. This isn't a temporary blip, it's a permanent shift in how we work. Now, here's the problem. Those buildings were bought with huge loans, mortgages taken out when interest rates were super low, around 3%. Those loans are now coming due, and they have to be refinanced at today's much higher rates, somewhere around 7% or 8%. Let me break down what that means. Imagine a building's rental income was just enough to cover its 3% mortgage payment. Now that payment has more than doubled, but the rental income has actually gone down because of all the empty offices. The math simply doesn't work anymore. The building is a financial black hole. So what are the owners doing? They're walking away. They're literally mailing the keys back to the bank and saying, "It's your problem now." We saw this with Brookfield, one of the biggest real estate owners in the world. They defaulted on huge office towers in Los Angeles, not because their company was going broke, but because those specific buildings were worth less than the money they owed on them. It was just a cold, hard business decision. And this is just the beginning. Over $2 trillion in these commercial real estate loans are coming due over the next couple of years. If even a third of them go bad, that's over $600 billion in losses. And who gets stuck with that bill? The regional banks. Not the giant Wall Street firms, but the smaller local banks in your state or your city. Their vaults are stuffed with these loans. When the loans go bad, the banks have to admit they've lost billions. And those losses chew through their safety cushions. When that cushion is gone, the government has to shut them down. We already saw the tremors before this earthquake in 2023 with the collapse of Silicon Valley Bank, Signature Bank, and First Republic. A cascade of these failures would spark a full-blown panic. The second possible trigger is a major company going bankrupt, or even an entire country defaulting on its debt. During the era of easy money, hundreds of big corporations took out ridiculously cheap loans. Now that debt is maturing, they have to roll it over at rates that are double or triple what they were paying before. Some of them simply won't be able to afford it. If a big, well-known company, a name you see every day, suddenly announces it can't pay its bills, it sends a shockwave of fear through the entire system. Investors who own that company's bonds panic and start selling other corporate bonds, worried they might be next. It's like seeing one person in a crowded theater yell, "Fire!" Even if you don't see flames, you start running for the exit. This freezes the credit markets, making it impossible for anyone to borrow money, leading to even more bankruptcies. That's exactly how the 2008 crisis spread from Lehman Brothers to the rest of the world. A country defaulting is the same idea, but on a much larger scale. If a major emerging market country announces it can't pay back its loans, investors everywhere will start asking, who's next? They'll pull their money out of other countries, causing currencies to collapse and triggering a global domino effect. This isn't a distant problem because the banks that lent them that money are often the same big banks in the US and Europe. The fire that starts overseas will quickly spread right back to our shores. The third trigger is a geopolitical shock. This could be anything. A major war, another pandemic, a large-scale terrorist attack, or a chaotic political crisis at home. The COVID crash in early 2020 was this kind of trigger. The virus wasn't an economic problem at first, it was a health crisis. But the sheer uncertainty it created, the feeling that nobody knew what was coming next, forced everyone to sell. In a moment of true crisis, people don't care about making a profit. They care about survival. They sell everything and run to the safety of cash. Any major shock that disrupts the world could spark that same desperate rush for the exits. In the end, it doesn't really matter which of these triggers pulls the pin on the grenade. The real problem is the grenade itself, the extreme prices and the crushing debt. Once the selling starts, a brutal and predictable mechanical process takes over. Let me walk you through what happens next based on the patterns of 1929 and 2008. The timeline might be a little faster or slower, but the sequence of events is always the same. It begins with phase 1, the initial shock. The trigger event happens. A bank fails, a company goes under, a conflict erupts. The markets drop hard and fast, maybe 10 or 15% in just a few days. Most investors are caught off guard, but they aren't truly panicked yet. In fact, many see it as a gift. For over a decade, they've been trained to buy the dip. They think, great, stocks are on sale. The Fed will step in soon and fix everything. The news channels bring on experts who say the economy is still strong and that this is just a temporary overreaction. Back in 1929, the first big drop was called Black Thursday. The market plunged, but then a group of powerful bankers got together and publicly pledged to support the market. It created a moment of false hope, a brief recovery that calmed everyone's nerves. It was the market's last deep breath before the real plunge. Everyone who had panicked and sold felt foolish. Everyone who had bought the dip felt like a genius. They believed the worst was over. It's a classic move in this playbook. In 2008, the first shock was the collapse of a big investment bank called Bear Stearns. The market dropped about 15%, but then the Fed stepped in and arranged a rescue. Crisis averted, or so everyone told themselves. In our future crash, this first shock will look very similar. A big bank will teeter on the edge, or a wave of companies will default. The market will drop 10 to 15%. And then, right on cue, the Fed will issue a statement, something calming like, "We are monitoring the situation. The financial system is strong. We stand ready to provide whatever is needed." Investors, conditioned for years, will hear this and rush back in to buy. The market will recover some of its losses, but a crack will have appeared in the wall of confidence. The damage is done. This leads us to the second and most dangerous phase, the false recovery. After that initial scare, the markets will calm down. They might even slowly drift higher for weeks or even a few months. This is the deadliest part of the entire process because it tricks everyone into thinking the danger has passed. It's like the ocean pulling back just before a tsunami hits. People wander onto the exposed sand, fascinated, having no idea the wave is coming. In 1929, after that first big drop, the market actually rallied for a week. Investors who had sold kicked themselves. Then, the real crash began, a relentless slide into darkness. In 2008, after Bear Stearns was rescued in the spring, the market limped through the summer. By July, it was only down about 10% from its all-time high. The experts on TV were declaring the bottom was in, that the crisis was contained. Then September came, Lehman Brothers failed, and the floor fell out, with the market crashing 40% in just 6 weeks. Following this script, the false recovery of 2026 could last for a few months. The initial problems will be explained away as isolated incidents, bad management at one or two companies, not a sign of a sick system. The Fed might even cut interest rates a little to boost confidence. The markets will rally, but beneath the calm surface, the cancer is spreading. The debt problems are getting worse, and the clock is ticking. Then comes phase 3, the cascade. This is it. This is the real crash. It's a terrifying waterfall of forced selling, margin calls, and pure, unfiltered panic. In the Great Depression, this cascade went on for almost 3 years. In 2008, it was much faster, a brutal 6-month collapse. The next one will likely be a horrifying 12 to 18-month waterfall, wiping out 50, 60, maybe even 70% of the market's value. Here's how it works, step by step. First, the investors who borrowed money to buy stocks get wiped out. Imagine you bought a stock for $100, but you only put up $50 of your own money and borrowed the other $50. If that stock falls to $75, you haven't just lost 25%, you've lost 25 of your original $50. You're down 50%. Your broker calls you and says you need to put up more cash immediately. That's a margin call. If you can't, they sell your stock for you at any price they can get. Now multiply that by millions of people all getting that same call at the same time. Their forced selling pushes the market down even further, which triggers even more margin calls. It's a death spiral. Next, the big players, the mutual funds, the hedge funds, the pension funds, start to bleed. As their portfolios shrink, their own investors get scared and demand their money back. To pay these people, the funds have no choice but to sell even more stocks, dumping huge blocks of shares into an already falling market. This adds massive selling pressure. Then, the robots take over. A huge portion of today's trading is done by computers running complex algorithms. These programs are designed to detect trends, and when they see prices falling fast, they are programmed to sell instantly to cut losses. They don't think. They don't feel fear or greed. They just execute orders, accelerating the decline at lightning speed. It's like a stampede of robot elephants. As this is all happening, the buyers disappear. Think about it. When everyone is desperately trying to sell, who is left to buy? The market becomes a one-way street. Bids simply vanish. A stock that was trading at $50 might reopen at $40 because there isn't a single buyer anywhere in between. The market isn't just declining anymore, it's collapsing under its own weight. Finally, the plumbing of the entire financial system freezes solid. Because when panic is this high, banks slam their vaults shut. They stop lending money to anyone, even to each other. Why would you lend someone money today if they might be bankrupt tomorrow? This is called a credit freeze. And for the real economy, it's a catastrophe. Companies that need short-term loans to operate suddenly can't get them. They default. The banks that lent them money take huge losses. The whole vicious cycle accelerates, feeding on itself. This is the point where the stock market crash escapes Wall Street and comes for Main Street. Trillions of dollars in paper wealth evaporate. People see their retirement accounts cut in half and feel poor, so they stop spending money. When people stop spending, businesses lose revenue. When businesses lose revenue, they lay off workers. Unemployment skyrockets. And those newly unemployed people have to cut their spending even further, which causes more businesses to fail and more people to lose their jobs. This is the devastating feedback loop that turns a market crash into a full-blown economic depression. This leads to phase 4, maximum panic. This is the bottom. This is the point of absolute soul-crushing despair when people are so terrified that they sell everything they own at any price just to have cash. In 1932, this was the moment the market was down 89% and a quarter of the country was unemployed. In March of 2009, this was the moment the market was down 57% and the entire global banking system was on life support. This is the moment of maximum fear and, for a select few, maximum opportunity. And finally, after the wreckage settles, we get phase 5, the slow recovery. This only begins when the government is forced to intervene on a scale that is hard to even imagine. In the 1930s, it was the New Deal. The government had to literally remake the economy. Even then, the recovery took over a decade. In fact, the stock market didn't get back to its 1929 peak until 1954, a full 25 years later. In 2008, the government stepped in again, bailing out the big banks. The Fed fired up the money printers to the tune of $3 trillion, and Congress passed massive stimulus packages. Because of that aggressive action, the recovery was faster. The stock market hit new highs just 4 years later, though it took the real economy a bit longer to fully heal. Now, when our future crash hits, the government will try to run the same playbook. They will intervene. The Fed will slash interest rates back to zero. Congress will authorize trillions upon trillions of dollars in stimulus money. Banks will get another bailout. But this time, the recovery could be much, much slower than in 2008. For one simple reason, the debt is already astronomically high. Our government already owes more money than our entire economy produces in a year. Adding trillions more in stimulus will push that to levels where just paying the interest on the debt starts to eat up a huge chunk of all the taxes the government collects. At that point, there are only terrible choices left. Slash spending, raise taxes through the roof, or just print so much money that the debt becomes worthless, which would destroy the savings of everyone. The recovery from this next crash could easily take 5 to 10 years. The stock market might not see its 2025 levels again until 2032 or even later. So that's the pattern. The initial shock, the deadly false recovery, the brutal cascade, the panic-filled bottom, and the long, slow recovery. It's a script that has played out before and will play out again. Now, let's talk about the most important part of this story. Who gets destroyed and who gets rich? Because every single one of these crashes is, at its core, a massive transfer of wealth moving from the people who don't see it coming to the very few who do. So who gets destroyed? The middle class, the regular people who own stocks and homes. In the 1920s, a whole generation of middle-class families had started investing in the stock market for the first time. They felt rich and optimistic in 1928, but by 1933 they were wiped out. Their stocks were down 90%. They lost their jobs, couldn't make their mortgage payments, and their homes were foreclosed on. In 2008, it was the same story, but this time the weapon of choice was housing. Middle-class homeowners who had bought at the peak of the bubble watched the value of their homes plummet. Many found themselves underwater, meaning they owed more on their mortgage than their house was actually worth. Millions lost their homes to foreclosure. In the coming crash of 2026, the same tragedy will repeat. Regular families with their retirement money in 401ks will watch in horror as their accounts are cut in half, or worse. A $500,000 retirement nest egg could shrink to $200,000. Decades of hard work and savings gone in a matter of months. People who bought homes at today's inflated prices will see their values collapse. And for retirees, the timing is a catastrophe. Imagine you're 65 years old, ready to retire with what you thought was a comfortable nest egg, only to see it vaporize right when you need it most. Small business owners will be decimated. When people stop spending, businesses lose their customers. They can't pay their rent, they can't pay their employees, and they have to shut their doors for good. In the 2008 crisis, nearly 200,000 small businesses failed. This time, that number could be much higher. Restaurants, shops, local service businesses, all gone. The owners lose everything: their business, their life savings, and often their own home, which they used as collateral for a business loan. And of course, anyone who borrowed money to invest gets completely wiped out. Whether they were using margin to buy stocks or taking out mortgages to buy rental properties, they faced a brutal end. They are forced to sell at the absolute worst possible moment, at rock bottom prices. They don't just lose what they invested, they end up with a mountain of debt on top of it all. For them, it means bankruptcy, ruined credit, and a financial hole that can take decades to climb out of. Now, who profits from all this chaos? This is the most critical part to understand. Every crash makes someone fantastically rich. In 1929, men like Joseph Kennedy made fortunes by betting against the market. Others held cash and gold, waiting patiently to buy up incredible assets for pennies on the dollar during the Depression. In 2008, a handful of investors like John Paulson and Michael Burry became billionaires by betting against the housing market. Warren Buffett swooped in during the panic and made billions by lending money to giant banks when no one else would. The playbook for the 2026 crash will create the next generation of billionaires, and it's the same playbook. The winners will be the people holding cash, the investors who were smart enough to sell their stocks before. The crash should just sit on piles of cash or safe government bonds. When the stock market falls 60%, their cash doesn't lose a penny. In fact, its buying power skyrockets. While everyone else is panicking and losing half their net worth, the cash holders are calmly waiting. Then, at the moment of maximum fear, they deploy that cash. They buy up stocks for 40 cents on the dollar. They buy foreclosed real estate for half of what it was worth a year earlier. They buy entire businesses that are being sold for scrap. Warren Buffett, for instance, is already sitting on hundreds of billions of dollars in cash, waiting. When the crash comes, he will do exactly what he did in 2008, but on an even bigger scale. The short sellers will also make a fortune. These are the investors who place bets that specific stocks or sectors will go down. In the next crash, the obvious targets are commercial real estate, regional banks, and all those companies drowning in debt. If you short a bank stock when it's trading at $50 and it collapses to $5, you make a massive profit. The big hedge funds are quietly building these positions right now. It's the same trade that made a few people famous in 2008. Gold holders will profit. During the Great Depression, the government was forced to devalue the dollar, and the price of gold shot up nearly 70% overnight. During the 2008 crisis, gold more than doubled in value. Why? Because when a crisis hits, the government's only response is to print unbelievable amounts of money. That massive money printing makes the dollar worth less, and gold, which can't be printed, becomes more valuable as a haven. And finally, the distressed debt buyers will profit. When companies go bankrupt, the loans they owe don't just disappear. They get sold off for pennies on the dollar by panicked investors who just want to get something back. So-called vulture funds swoop in and buy up these loans for, say, 20 cents on the dollar. Then they wait for the company to restructure, and eventually they might collect 50 or 80 cents back. It's a way to triple your money by buying up the wreckage. And finally, real estate investors with cash will have a field day. As foreclosures spike, beautiful homes and giant apartment buildings will be sold at auction for a fraction of their former value. Big investment firms will come in with billions in cash and buy up entire neighborhoods. They'll rent them out for a few years, wait for the market to recover, and then sell them for enormous profits. This is exactly what giant firms like Blackstone did after 2008, buying up tens of thousands of homes and becoming the biggest landlords in the country. This is how generational wealth is created. The firms and families that see the crash coming, that prepare for it, and that dare to act when everyone else is panicking, create dynasties. This is the great wealth transfer. It's not illegal. It's not a conspiracy. It's simply understanding the predictable cycles of the economy. Crashes don't actually destroy wealth. They just transfer it from the unprepared majority to the prepared few. So let's put the coming crash side by side with 1929 and 2008. What's the same and what's different? What's the same is the fundamental machinery of the bubble. All three crashes started with prices for assets getting completely disconnected from their real value. In 1929, it was stocks. In 2008, it was houses. In 2026, it's everything, all at once. The amount of leverage, the sheer volume of debt, is also the same story. Borrowed money to buy stocks in the 20s, risky mortgages in the 2000s, and today, a record-breaking mountain of government, corporate, and personal debt. And, most importantly, the belief is the same. The dangerously naive idea that this time is different. They said it in 1929, they said it in 2008, and they're saying it now. Every bubble is built on the myth that it will never pop. They are all wrong. The mechanics of the crash itself are also identical. The forced selling that triggers more forced selling, the credit markets freezing up, the raw animal panic. These are not emotional reactions. They are mechanical processes. Once you pile up enough debt, any trigger will start the avalanche. And finally, the wealth transfer is the same. The people holding cash, gold, and short positions come out richer than ever. The people who are fully invested, leveraged to the hilt, and completely unprepared, get destroyed. This core pattern has not changed in 100 years, but what's different this time is absolutely terrifying. First, the sheer scale of it all. The size of the U.S. stock market in 1929 was about $80 billion. In 2008, it was around $12 trillion. Today, it's over $50 trillion. The numbers are so massive, they're hard to comprehend. We're playing the same game, but on a board that is 4 times larger than it was in 2008. The potential losses could be north of $30 trillion. Second, the speed. The 1929 crash took 3 long years to hit bottom. The 2008 crash took about 6 months. The 2026 crash could be even faster. With algorithmic trading, instant global communication, and social media spreading panic in seconds, the entire collapse could happen in a matter of weeks. Third, the global interconnection. The 1929 crash was mostly an American event that slowly spread to the rest of the world. 2008 was a global crisis, but some emerging market countries were able to recover fairly quickly. 2026 will be the first truly, deeply, and instantly global crash. China, Europe, the US, and emerging markets, our financial systems are now so tangled together that a fire in one house will instantly ignite all the others. There will be nowhere to hide. Fourth, and perhaps most frightening, is the government's ability to respond. Back in 2008, the government had tools. They could cut interest rates from 5% to 0. They had room to borrow and spend trillions. Today, interest rates are already low, and government debt is already at crisis levels. The Fed has already printed trillions. They have far less ammunition to fight this fire than they did the last one. Their response will have to be even bigger than before, but it will be far less effective. And finally, the social consequences. The crash of 1929 fueled political extremism around the world. The 2008 crisis gave us deep political polarization. A 2026 crash could create something much worse. Wealth inequality is already at extreme levels. The middle class has been hollowed out for decades. If this next crash destroys what little wealth they have left, the political anger could become explosive. This isn't an exaggeration, it's a historical pattern. When economic crashes wipe out the middle class, political systems become dangerously unstable. So let me lay out a plausible timeline for you. Again, these aren't exact dates, but a projection based on the historical pattern. Right now, in early 2025, we are at the peak of the bubble. Sometime between the middle of this year and early next year, the trigger event will happen. A wave of bank failures, a major corporate bankruptcy, a geopolitical shock. The market will have its initial 10 to 15% drop. Then, in the spring of 2026, comes the false recovery. The market will stabilize, maybe even rally, and the experts will declare the crisis is over. This is the trap. Then, starting in the summer or fall of 2026, the cascade begins. The real free fall. Sometime between the end of 2026 and the middle of 2027, we will hit the bottom. Maximum panic, unemployment near 10%, major banks failing, and the government finally stepping in with a massive, desperate intervention. That will be the moment of maximum fear. And after that moment of maximum fear comes the long, slow recovery. From late 2027 through the end of the decade, the economy will begin to heal. The markets will stabilize and start a long, grinding climb back up. Unemployment will slowly fall, but the damage will be immense. Don't expect a quick V-shaped recovery. This will be a slow, painful process. The stock market likely won't see its 2025 peak again until 2030, or maybe even later. This timeline could shift by a few months in either direction, but the sequence of events is locked in. The pattern has been right twice before, and it is screaming that the crash will come in late 2026 or early 2027. So the natural question is, what can a person do with this information? Now, let me be crystal clear. This is not financial advice. I'm a pattern analyst, not your financial advisor. My goal is to show you the pattern. You must decide what to do for your own situation. But if we look at what worked for the people who survived and even thrived during the crashes of 1929 and 2008, a few clear strategies emerge. First, consider reducing your exposure to the stock market. If your entire life savings are in stocks, you are sitting on the train tracks as the locomotive approaches. This doesn't mean selling everything and hiding in a bunker. It means taking some chips off the table, moving some of your portfolio into the safety of cash or short-term government bonds. Yes, you might miss out on the last few months of a bubble's gains, but you will preserve your capital when the crash finally comes. It's about protecting your downside, not perfectly timing the top. Second, consider holding some gold. Whether it's physical gold or a fund that tracks the price, history shows that gold is a safe harbor in a storm. Think of it as financial ballast for your ship in a hurricane. When the crash comes and the government inevitably turns on the money printers to try and fix it, the value of the dollar will fall, and the value of gold will likely surge. Third, make your shopping list now. Create a list of the highest quality, most dominant companies in the world, the ones with fortress-like balance sheets and very little debt. Companies you would love to own for the next 30 years. And then, wait. When the crash happens, and these incredible companies are on sale for 50 or 60% off, that is your time to buy. Fourth, and this might be the most important, prepare yourself psychologically. The strategy is simple, but executing it is incredibly difficult. When we hit the bottom, your stomach will be in knots. The world will feel like it's ending. Every headline will scream, sell. Your own survival instincts will be telling you to run for the hills. Buying stocks at that moment will feel like the most insane thing you could do. But that is the exact moment when fortunes are made. You must prepare your mind now so you dare to act when everyone else is paralyzed by fear. Fifth, fortify your own personal economy. If a deep recession and layoffs are coming, you need to make yourself indispensable at work. You need to aggressively pay down personal debt, especially high-interest credit card debt. And you absolutely must build an emergency fund, a cash buffer that can keep you afloat if you lose your job. And finally, watch the warning lights on the dashboard. Keep an eye on the default rates for commercial real estate. Watch the stock prices of regional banks. These will be the canaries in the coal mine. When you see them start to fail, you know the cascade is beginning. Now, is the crash of 2026 an absolute certainty? No. It's possible the powers that be can engineer some kind of soft landing, so that these massive bubbles will deflate slowly instead of popping violently. But the historical pattern says otherwise. Twice before, when all these conditions aligned just as they are now, a devastating crash followed. A crash that destroyed the unprepared and created unimaginable wealth for those who saw it coming. The setup is complete. The bubble is inflated. The debt is at a breaking point. And the belief that the party will never end is everywhere. All we're waiting for is the trigger. And when it comes, the 5-phase pattern will play out with brutal precision. The initial shock, the false recovery, the cascade, the panic bottom, and the slow recovery. Wealth will be transferred on a scale we've never seen before, from the middle class to the prepared elite. Lives will be shattered, but fortunes will be made. In a decade from now, academics will write books analyzing why nobody saw it coming, even though the pattern was staring us right in the face. If this analysis has shown you a pattern you'd never seen before, if you now understand that these crashes are not random accidents, if you recognize that the world today looks eerily similar to 1928 and 2007, then you have a choice. You can ignore the pattern and hope that this time, for the first time in history, it's different, or you can recognize the pattern for what it is and position yourself accordingly. The pattern doesn't guarantee the future, but it has a perfect track record. The Great Depression, the global financial crisis, and coming soon, the Great Reset of 2026. 3 events, 1 pattern. The only question is whether you'll learn from history or be doomed to repeat it. The setup is complete. The pattern is repeating. The crash is coming.